Now, if you're a forex trader, this is the most important video you're going to watch on the forex market. I don't care whatever strategy you're using, this is the very video that is going to clear up a lot of air. It doesn't matter if you're using support and resistance, trend lines, Fibonacci, order block, SMC, ICT, whatever it is. This is a very important concept that I believe if you do watch it to the very end, it's going to clear up a lot of things for you. So watch this video to the end to be more inspired. What is up, guys? It's KOJOFOREX, aka GPP Emperor, aka Emperor of Blues. In today's video, I'm going to show you something that I've never talked about on my YouTube channel before. A lot of you have been watching most of my videos. You see normally that on my screen I would normally have a very horizontal line, and you're asking, Kojo, how did you come up with these horizontal lines? What do they mean, and then how can you explain that to us? But I've not really taken much time to explain it until today, right? So when I want to talk about what lines you see on my chart in terms of the horizontal lines, they form under a category of a concept that is not very popular on the YouTube space. It's something that was propounded just around the year 2010 by a very brilliant trader who existed. I think he still exists though, right? So shout outs to KOJO, right? He is the propounder of that concept that I embedded in my strategy. So that concept basically called Cortez theory, right? But I did my thorough research into it, reading and then understanding and back testing so many of these concepts that he explained, and try to see how uniquely it appears on the market. And I found a true answer to what I was looking for, and I intended that I'm going to inculcate it in my personal studies and my personal analysis. So first of all, what I did was I understood the reality of the concept. So before I even go into the chart, I'm going to try and explain the reality of this concept so that you understand the perspective to which it explains itself, right? So the Cortez theory basically says that the market does not really move in a random nature, right? Even though we all understand that yes, indeed, the market does move in a random nature and then it has no direction it's going. Institutionally, Cortez theory kind of believe that the market has a level that it tries to aim for at any point in time at all, and then when that level is reached, it tends to want to reverse, right? It could be fundamentally driven for that reason where the market wants to reverse, or perhaps like any other reason at all that it may be economically driven. There's a war, there is a corona, whatever it is, right? Or it's pretty much even embedded in fundamental in the first place, right? But the whole logic is that the market will move from one round number cross quarterly onto the next round number. So at the end of the day, the summary is that when you think about the Cortez theory, it puts the market in a cap of 1,000 pip, right? So once the market is captured in a cap of 1,000 pip, it says that from that one point of a round figure, whether be it on the support level or on the resistance level, the market is likely going to travel from either quarters of it to the next level and then reverse or play in between those ranges, right? So I'm going to give you an illustration from an example that I'm going to just illustrate here on this book. So think about it this way, guys, right? Let's say we're talking about the Euro USD, for example. So the currency pair here is Euro USD, right? And all things because let's say they are at parity, right? Which means that Euro USD exchange rate is what? 1.0000, right? Now 1.0 adding 1,000 pip to that basically takes us to 2.0, right? So if you didn't know that, then that's it. So 1.000 to 2.000 is an interval range of what? 1,000 pips. Now that we are clear that we have 1,000 pips here, what Cortez theory is basically saying that the market will easily trade from one point here and travel in between ranges onto the next point here, right? Now it's going to be very difficult for you as a trader to easily just wrap your head around and say, okay, it's going to travel from one point here to the next point. And how does that information in fact does help you in any way? So what you do is that in the concept and understanding the application of it, right, you want to go further down in breaking down the quarter range, which is like that 1,000 pip range that you have established, right? So how do you do that? You first divide into 500 equal halves, and then you go further on to divide it into 250 equal halves. So that's like a standard procedure that you want to follow. Bear in mind that the way I'm illustrating this is pertaining particularly to currencies, right? You could innovate yourself into applying it into indexes and metals, but for the meantime, as far as this explanation is concerned, I'm doing everything pertaining to currencies, right? So in order to make this video quite long, I'm going to try and ration a little bit, but hopefully you're able to catch on and then understand the whole logic. So once you divide it into equal halves, what you have here is what? Here being 1.50000, right? Now you can use a mobile phone calculator, or you can use any scientific calculator to do that calculation if you don't feel comfortable using your head to calculate that, right? Now you can also understand that at that point, then this range here, right? This range right here is made up of what? A 500 pip, and then the one right here also is what? 500 pip range, right? Now we go on to divide the 500 into another equal halves again, right? That puts us into dividing this range here, which is going to be what? 1.2500, and then we have another range here which is going to be what? 1.75 How did I come by the 1.2500, 1.7500? If you want to come by again, I've established you a simple mathematics arithmetic, right? Adding two figures and then dividing into two. How do you add it? You add 1.500 plus 1.000 divided by 2 is going to give you 1.2500. Or you can do 1.500 plus 2.000, then it's going to give you 1.7500. So at the end of the day, you realize that I've divided this into 4 equal halves of what? 250 here, 250 here, 250 here, and 250 here. Right now that you can see that the context theory is basically saying that this market is going to have a random walk of movement in between this range, traveling from support region, resistance region, Fibonacci trend line, whatever it is, order blocks, fair value gap, institutional levels, ranges, whatever concept at all that you use on the market is just going to be trading in between these ranges in this manner, right? So now at the end of the day, how does that benefit you as a trader? It gives you a realistic perspective and a range in which you can cap this market into. Once you have that realistic perspective, it also kind of guides you to even place your take profit into the next quarterly range, right? So what do I mean by that per se? So let's say you are a trader and then you've been able to understand this concept and then you've applied it in your own strategy or concept that you're using, right? Let's say you were able to cap out Euro USD and then found a trade entry, or you saw it approaching the 1.00 parity, right? It got there, you found your order block, you found your support level, resistance, liquidity, whatever it is, and then you got in on the trade here for a buy, right? Instantaneously, you can understand that based on this quarter level, the market anticipating that it's going to go on a bullish level, you're anticipating that it's going to go on the next quarterly level, which is anticipating that this market could easily travel from here and approach what 1.2500. So at the end of the day, it gives you a realistic expectation of where the market is going. So you're even more patient, right? So I get a lot of people also asking me, Kojo, how are you able to be very patient and hold your trade on those kind of insane swing positions, right? So this is that ease that I apply in able to do that, right? Because the moment I take that trade at that region, I'm already thinking that, okay, since I'm anticipating that it's going to go here, why not allow it to play? And I've seen this outplay itself thousands of times, 10,000 of positions that I've taken on the market. So I do really know that it works, and that's why I'm showing you, right? So now what I'm going to do next is illustrate it physically on the market for you. Apply everything that I've taught you here also on the market so that you see that the reality of it when being applied on market circumstances as well. I'm going to first introduce you to a very exotic currency pair that most of you have perhaps not even taken insight into looking into it before, and it's not your fault, but of course we need to understand that before we can be able to progress from where we are. Now that's also a currency pair that is pegged to the United States dollars, right, which is the United States dollar versus the Hong Kong dollar, right? So it's very fundamentally driven, but after I use this context theory to kind of break down that, I'll also show you the very actively traded currency pair that I'm going to use the same illustration to guide you on, so that now you can apply it in your concept if you so wish, right? So first off, let's look at USD HKD, which represent the United States dollar versus the Hong Kong dollar. Now bear in mind, I've already marked up this chart already, but I'm going to use a chart to do that illustration, and then I believe that you're going to get the whole idea. If you look at this, right, this is the United States dollar versus the Hong Kong dollar. What I want to first do is switch on the monthly time frame. Now if you want to apply this concept, understand that the time frame that you want to apply it on is based on the monthly time frame, right? So you can see here that what for the past God knows how many decades now, the United States dollars have been pegged successfully to the Hong Kong dollar, but it has also been pegged in a specific range, right? So I'm sure you're surprised that, wow, Kojo, do we have a chart like this appearing on the market? Yes, indeed, a chart like this do appear on the market. And because it's pegged and it's an exotic currency pair, you mostly find only institutions being interested in trading this because the swap rate for this is extremely high. I've personally tried shorting this year and it was a legendary trade. Everybody have seen me, especially people that connect with me on all social media, KOJOFOREX, Twitter, Instagram, right? I do post some of this obscure chart, and I told them that I was holding this position. In fact, I held this trade for a long time until it started really eating heavily into my swaps and I had to exit. But that's a conversation for another day. The one that we are particularly focusing on is the range between this level right here and then this level right here. You can see that what you can see right here that expands all the way from the 7.7500 region all the way to the 7.8500 region, right? And that is a 500 pip range. And you can see that from what I illustrated to you in the earlier example, I have successfully divided this into 500 equal halves, which is this range right here, and then 250 equal halves, which is here and here as well, right? And you can see that over the years, United States dollar, Hong Kong dollar has successfully been playing between these ranges based on the context theory that I just introduced to you. Now let's take a fresh example where I have not marked it already, and let's see what would they have done according to the concept I'm teaching you. If you look at this, I'm currently on the New Zealand dollar, Canadian dollar, right? Now I'm going to also try and infuse a little bit of fundamental play here so that you understand the reality to which this topic that I'm discussing with you is extremely important and an eye-opener. It's going to change the game for you forever. Now if you look at this, what you want to do is that, of course, you want to look at the most relevant trading range before you tend to illustrate the quarter ranges on it. Right now you can see that when we zoom all the way out, New Zealand dollar, Canadian dollar, it's actually been trading from different variants of ranges, right, over the past years, you know, starting from the exchange rate of 1.1500 and then the lowest being 0.6100 region thereabout. Right now we may not necessarily be able to just apply 1,000 pip range here, right, when the market is actually trading in a different range, which is like this range right here, right? So you want to apply the concept in the most relevant range being where the market is trading around, right? So you can see that now I'm still on the monthly time frame, and then we're looking at where the market is particularly trading around. What you want to also do uniquely is you want to first also target lows in the market, lows in the monthly time frame, which is like support regions in the monthly time frame on the most relevant ranges. That is where it stands as a basis for you to start plotting your 1,000 pip range, right? So first you want to see that now that I want to establish this on the New Zealand dollar, Canadian dollar, I have to look out for what the lows here. And then what am I particularly looking out for on the lows here? I'm looking out for round figures, right? Rounded psychological figures that my mind's eye can easily locate around that range, right? Now you can see here that if I zoom out this by removing the line, you can see that the very number that points itself out to you easily from that range is this 0.77 round figure or 0.77 exchange rate number. So what you want to do is that you pick that one as your initial psychological level, which is like that support level, monthly support region. Right now, once you've picked that, it's easy for you to wrap your head around that. If 0.77 is starting point of the range, then adding 1,000 pip basically takes us to what? 0.8700, right? Now I've done this already for a long time, so of course you must understand that I have easier move around it, but you should take your time to master understanding the 1,000 pip, and then it will make so much sense to you, and it will be very easy on your mind's eye if you're doing subsequently, right? Now division for that will easily place us in this mid range right here, which is just about 500 pip differential. So you're going to understand that this will easily put us to 0.8200, right? Now you can do the math for yourself. All you got to do is add 0.77 plus 0.87 and then divide it by 2. Pretty much sure it's going to give you 0.8200, right? Then next off, you understand that by this range we have already divided this market into 500 equal halves, which is one range here and then the other range here, right? So 500 half equal halves, but we're going further to break it down into another 250 equal halves. So you can see that I put a random line there and I put a random line here, but we're going to be very specific with it because we're trying to get the most rounded perfect equation here. So here is going to be 0.7950, which is going to give you that 250 equal halves, and then here is also likely to be 0.8450, right? So here is going to be 0.8450. So at that point you can see that I have successfully carved out New Zealand dollar, Canadian dollar into a perfect 1,000 pip range, starting from 0.77 all the way to 0.87, right? Now at this point, once you're done, you can now apply your concept, right, to the market, your everyday logic to the market. Whether you're using, again, I've established that, whether you're using support level concept, resistance, trend line, moving averages, you're using order block, SMC, whatever concept at all, as far as you've been able to easily cover the market in this type of a range, then you can do that. I'm going to show you something very powerful, applying fundamental as well to this concept, and then you're going to see how insane it even gets, right? Now you realize that from this point, because I trade on the 4-hour time frame, then I would need to just easily come here and then see the interaction of the market within those ranges that I have already carved out here. So let's say the market moved from one point, I'm looking at the next point is going to get to, and then if it's dropping, I'm going to look at the next point is going to get to, and so on and so forth, right? Now let's observe certain realistic characteristics of this range that I've taught you on, let's say, the daily time frame, right? Now if you look at the daily time frame, what can you clearly observe? You can see how beautifully this market traveled from that psychological level of 0.8700, came all the way down to 0.7700, went all the way back up to 0.8700 region, using that again as a resistance level. It already used here as a support level, and now you can see that it's literally creating lower high, lower low on the daily time frame. And then are we going to now make a new high here, new low, and then perhaps approach back to this region? The future is yet to tell, but now you can already see how powerful this can give you a perfect illustration of what the market can do sometimes, right? So what I just intended to show you uniquely about these ranges is you realize that we always say the market is majorly fundamentally driven, but nobody has truly been able to illustrate to you how is the market really fundamentally driven. This video is the one that is going to perfectly show you the logic behind why we say the market is fundamentally driven. And once you're able to understand the fundamental analysis, you can then apply your technical to understand the long-term direction of the market and apply your technical concept to find trade setups thereof, right? Now you realize that what I wanted to do here is understand what fundamental majorly drove this market from these lows, right? You can realize that this is the region on which the market decided to turn. This is like the major turning point of this market before it took off all the way up to the next 1,000 pip region, right? Time may not permit us. Other than that, we would have also looked out for the real logic behind why this market turned from here. But you can easily apply what I'm showing you to what is going on here, and then you'll be able to successfully understand why this New Zealand card has been on a serious downtrend. But what I'm trying to break down to you now is why it went on this massive bullish trend, and then using fundamental to back the logic behind it, right? So what I did is I did investigate what happened around the market in those times. You want to easily do that with Forex Factory, right? Now Forex Factory is easily that website that is going to give you all the previous fundamental event that has happened in the market, and then you can just backdate and then do your personal investigation. So using this website, right, I am now going to trace to that region, right, where the market started turning. So you can see here it's just around the 10th October 2022. So we want to go here and look for 10th October 2022, right? So we come here 2022, we have September here, October is just around here, so 10th October here 2022, we apply it. Now I realize that 10th October 2022 there wasn't anything much going on in the market, right? So what do we want to do? We want to look out for the next date just around it. I'm using this vertical line here, I move it, then that's what 7th October 2022. So you want to switch on to a Forex Factory and come to 7th October 2022 and see. Now if we come to the 7th October 2022, voila, we have what? Canadian dollar unemployment change. So you can see what it was, a very positive number for the Canadian dollar, and that I believe strongly was that influence that pushed this volume, right? You can see this candlestick right here. Let me just briefly remove this line here. You can see that on that region, on that date, we specifically have this candle dropping heavily in that same region, right? Now you can see that if I introduce back that line, and that's on the 7th of October 2022, and then Forex Factory tells us that it was a positive unemployment change that influenced that volatility or that movement. But we want to go further on to understand what could have also perhaps change the fundamental drive from the market being bearish at this range to now becoming bullish, right? So you want to still do your investigation by moving further up, right, in terms of the date. So you come here, 8th October, nothing happened. 9th October, nothing happened. 10th October, nothing happened. 11th, it was just about a pound, which is not related to the currency pair we're watching. And then 12th, it was also pound USD, not related to the ones we're watching. Then we have Thursday, which is 13th, we had CPI, also pretty much not related. 14th, we had core sales, not related. Then 15, not related, right? So you do that continuously until you find that. You can see here, approaching 17th, then we had what? New Zealand dollar core CPI quarterly one, and then we had what? A strong figure, which is like 2.2% increase from the previous data of 1.7. Now what you want to do is you want to investigate that date. So it says what? 17th of what? 17th of October, right? Now if we come to 17th of October here, where do we find that? Exactly on this level right here. So you can see that 17th is exactly this one right here, right? Now I can see that since that unemployment from the Canadian dollar was released, the market just traded sideways in that region, which is this region that I've illustrated here, until another major fundamental came around to change the status quo of the market, which is like bringing in a new interest in terms of direction and positivity for the New Zealand dollar. So what you want to do then is, after the market has given you a good reason to understand that, okay, being that we have a strong CPI relating to the New Zealand, then the New Zealand is supposed to be very strong. It's supposed to have a strong bullish movement from there on, right? Now you want to come lower down into your time frame that you prefer, whether it's a 5 minute, whether it's a 15, whether it's a daily, 4 hour, hourly, right? And use that logic to find continuous trade in the direction of the market. So imagine that you have been able to now establish the fact that from here, I anticipate concurrently, from the fundamental perspective, the quarterly ranges, which is psychologically sitting on 0.77 region, and then all the concept that I'm applying from the one, whether it's a fair value gap, order block, or retracement region, or whatever it is, you can now continuously use that to look out for only bullish trade setup, because you know that once you're doing that, you're trading in the direction of the market. So you can easily do a thorough back test of how your strategy would have allowed you to find a trade entry within this range all through to this point, right? So from here all through to this point, and I'm pretty sure that it will give you a better understanding of how the market truly works, and you'll be able to stay profitable and catch huge pip movement from there on. If you really did love this video and want me to do much of this type of videos, you know what to do. Smash the like button. I promise you, this is the only channel that can teach you insane things like this. So you want to subscribe to this channel so that you don't miss any video that I upload. Click in the link in the description to purchase the KOJOFOREX Go strategy, because you know what, this is a glimpse of what I've just taught you. You can imagine the thorough deep things that I teach the good strategy members. I'm training market snipers that are going to take the future of this market to the next level, right? So you want to be a part of them. When you purchase a strategy, it doesn't only give you access to the online course, it also gives you access to our inner circle where we have conversation among ourselves, brainstorm, and have training sessions on every Sunday. Click in the link in the description to also join the KOJOFOREX Telegram community. It's the free community where I send trade signals for free every week, right? You're not going to pay anything at all. And connect with me on all social media at KOJOFOREX, Twitter, Instagram, TikTok. I hope you guys really found this video very informative, and I'm going to see you guys in the next one. Peace.